Hey folks, welcome back to the channel. It's Liquid here, and you've probably noticed that it's earnings season, which means stocks can get pretty volatile. I know that volatility can be a risk, but it also provides a great opportunity for option traders. I recently came up with this option selling strategy that's designed to take advantage of earnings reports. And that's what I'm going to share today in this video. Now, this strategy isn't going to make a lot of money, but because it has a fairly high success rate, it should generate lots of smaller profits over time, as I'll demonstrate in a moment. So, how does this work? The key concept here is to exploit falling IV. Of course, implied volatility, or IV, is basically the market's expectation of how much a stock's price will move in the future. And this is important because option prices are tied to a stock's volatility. When IV rises, so do option premiums. When IV falls, options lose value. What's neat about IV is it sort of follows a pattern, which means you can actually predict its movement with some level of certainty. For example, here's what the implied volatility looks like over time for the retail stock target. Notice how IV moves up and down in a somewhat predictable fashion. Every 3 months, there is a large drop, and that's because earnings are released during those times. And we can use this information to place high probability trades where the odds work in our favor. So the secret really behind this strategy is to sell an option right before earnings come out when the implied volatility is still elevated. And then after the earnings reports, the IV will be much lower. And it's at that time that we can buy back the option to cover our short position, or simply let the option expire worthless if it's still out of the money. We're basically selling high, buying low, and pocketing the difference as profit. Basically the buy low and sell high idea, just with a reversed order. In order to demonstrate how this works, I'm going to record myself placing real trades over this entire week. So by the end of this video, you should have a pretty good idea of how this works. I hope you'll enjoy this week-long trading session with me. So let's start at the beginning of the week. So we'll go over some examples today, which is Monday, the 15th. And I'm looking at some anticipated earnings release for this week. If we look at tomorrow, the 16th, on Tuesday here, we can see Walmart will announce before the opening bell, as well as Home Depot and Sea Limited. So this strategy basically involves selling a call option that is way out of the money, as well as selling a put option that is out of the money as well. So the call option, sell it at a really high price, and the put option at a very low price. So after earnings come out tomorrow, how high can the stock go, and also how low can it fall to? To determine those target prices, we can take a look at a couple of things. The previous price movements after Walmart gave earnings, and also technical analysis. So on tipranks.com, if you search for the stock Walmart and you click on earnings and scroll all the way down to Walmart earnings related price changes, you can see what happened to the price after 1 day of earnings over the previous few years. So we can see the lowest that Walmart fell was basically the last quarter. It fell by 11%, which is quite a lot for a blue chip stock like this. So could Walmart fall another 11% this time after releasing earnings? Well, it's definitely possible. So let's take a look at what the stock price would be if we take the current stock price of 133, and let's say we take 10% off of that. So times 0.9. That will give us roughly a 120 price target on the low side. So this is where the put option will likely be sold. And if I zoom back out all the way to, this is a couple of years, you can see roughly the 120 price range back in 2019. This price was resistance for Walmart. It was having trouble going over that. But then in 2020, the price of Walmart finally broke through. It came down, touched that 120 line, and then continued to go up. So instead of being resistance, this changed to being support. And the stock price basically hasn't really broke through that yet. So I think 120 is a pretty safe entry point if I were to buy the stock, which means I can sell a put option at that strike price. Now, for the call option up here, if we take a look at, again, the chart in the past, there was a huge gap down, which means there wasn't a lot of support during this time around May of this year, which means going back up, we're not likely to see a lot of resistance. So if Walmart stock does surprise on the upside, it's likely that it could go up all the way past this gap to, it looks like 147 or 148 level. So that's probably a safe area to sell a call option at. Okay, so call option at 149 and put option at 120. Now I'm going to jump into Interactive Brokers and look at the option chain for Walmart. The expiration I want to choose is the weekly, which means it's the option that is expiring the soonest. on August 19th, which is this coming Friday. So I want to turn on Strategy Builder because I want to sell a put option and a call option at the same time. Let's go to my put. I'm looking at around the 120 strike price over on the right side here where it says puts, and it looks like I can make about 23 or 24 cents. So if I click on this red 23 bid, it's going to add one sell leg here. And to add the other leg, which is my call, I need to scroll down to around the 149 level, which will get me to here. And this time I'm looking on the call side, and it looks like I can make about $16 or $17 with this option. So I can click on this, and now I have a short strangle option strategy. If I click on the profile here, we can take a look at why this strategy is favorable. We have a 94% chance to make a profit on this trade. So right now, if I put this order through, if I sell this option, I can make about $41. So by tomorrow, two things should happen. First is the IV here is going to get crushed because earnings are going to come out. So the higher the implied volatility, the more value the options are worth. And because I'm selling short, I want to sell the options right now when they are at maximum IV value. And by tomorrow, when the IV is lower, like maybe 20% or 30%, then the value of these options would be lower. So if I buy it back, I would be making a profit because I sold high and bought low. The other way to make money from this is through theta, which is time decay. Because there's only 4 days left before the options expire, you can see that this option is actually losing under theta here 11 cents per day. And then you can see the margin impact here. I'm using about $3,500 of capital to make $41. So that's why I say, it's not a lot of money, but that's about a little bit more than 1% return on your capital, which is not much. But when you think about it on an annualized basis, that's actually a lot, right? So I'm going to choose the mid here, 41, and submit order. So after commission, it'll be about $38 US. Okay, so we can see the order here. It hasn't gone through yet, but it is currently submitted, so we'll see how that goes. I'll move on to the next company, the Home Depot. I'll just type that into tip ranks here. It looks like the most it fell was about 9%, and then the highest it went was about 5%. So if I go back into Yahoo Finance, I can look at the chart for Home Depot. Let's say Home Depot goes up 9% from today's price, which is 314. We get 342. It's going to be about here. And it's also a previous resistance point back here in March where it tried to go up higher than that, but it got rejected and continued to fall. But what about on the downside? Let's take today's price and let's say it goes down 10% just to be safe. So if I multiply this by 0.9, I get 282, which will put it around here. There isn't really a clear support over here. We had some support back in May where it bounced off of that, but it fell through in June. So I think a much stronger support is actually down here at around 270. Not only is that the lowest point in the last year, but also in previous years, that seems to be a good support level. So it's not likely for the stock to fall below that. And around 342 for the call. So going back to IB
Order
here.
filled.
Okay, it looks like the Walmart short strangle got filled. I'm going to take a look at that later. So let's go ahead with the Home Depot trade here. So if I go to maybe like a 275, this one will probably work a little bit better because I'm going to click on sell leg. And for the call option up here, 342 or 343, that's over here. So at 345, this will give me a 1.8 standard deviation. So if I click on the sell leg here, and let's take a look at the profile. 95% chance. There's actually a 94% chance that I'm going to make all of the money, or $65. So if I go down to the submission area here, I can say, let's choose $67. Submit order, which will be about $64 after commission. Let's move on to the last one, which is C limited. This one's going to have a higher IV than the other two, so it's going to be a bit more difficult trying to pinpoint where the stock price could end up being. So let's see what we can do with this one. You can see there's a lot more variation here with the price movement after earnings. Back in 2019, the day after earnings came out, the stock popped 18%. And even though the lowest it can go is 13%, I'm still going to use 18% in either direction because it could really go either way. The stock is currently trading at $89. So let's say it goes up by 18%, which is like the most, or let's say 20% just to be a little more safe. That'll put the stock at 107 roughly. Now, I don't actually see a resistance here over the last month or so, so I have to zoom out, and it looks like the highest point I see, the last resistance is actually up here at 134. So if the stock wants to retest that level, then it can certainly go all the way up to like 139 or even higher around 145. Now, what about on the low side? If I take 89 and times it by, let's say, 0.8, so we're taking 20% off and going to the downside now, that's $71, which is about here. You can see the IV for this stock is off the charts. It's over 100%. If I click on that, it'll create the sell leg. And then for the call option, I want to do something around 140 or over just to be safe. So if I scroll down to 140, so that's barely any premiums there, but it's still better than nothing. So I'm going to sell this leg here. So it's going to be around $5, and that's okay. Let's choose 20, looks like 27, 28 is going to be the going rate. I'll go with 27. So I'll go ahead and submit this order. So Walmart has filled, but I'm still waiting for Home Depot and C Limited to fill. I'm going to take a look at what their price is now. Okay, so let's try 65. And for C Limited, I'll drop this to 26. Okay, let's lower this a little bit more to 64, and this way it'll get filled.
Order filled.
Okay, and then I'll lower this to 25. Just make
Order
$1
filled.
less. If I look in my trades here, I was doing these bottom 3 trades this morning, but basically the trades we can look at right now are these 3 short strangles on Walmart, Home Depot, and C Limited. If the stock price moves substantially higher or lower, then I will close that option because I don't want to risk it being by the end of the week going in the money, which means the stock price will either be below this line or it's going to be above this line, right? Because with short strangles, I only make money if the stock is within this range here between these two lines. And that's why it's so important to sell these with really short duration, like expiring at the end of this week. Otherwise, you're going to have more time risk if it continues longer. And if the stock price doesn't react too much, either up or down to the earnings reports, then I will most likely keep these options until they expire because that way I can capture 100% of the sold price here, assuming everything expires out of the money. So let's jump to tomorrow, Tuesday morning, and let's take a look at how these positions are doing. Okay, today is Tuesday. Let's take a look at Walmart first. The stock is up about 6%. So here are the pink lines that I want Walmart to stay within, and it looks like it is definitely within here. It jumped up from yesterday because of the strong financial report that investors seem to like. Okay, if I take a look at my account, so it's up $27, and if I open this up, we can see the put option here at 120 is basically worthless right now because the stock is so far away from this bottom pink line, the 120 strike price of the put, that there's basically no chance, virtually no chance for it to end up this week in the money. So that's why it's only worth 1 cent right now. For the call option, I set it to 149 for the strike, which is that pink line. And we are only at 140 today. So is there a chance it can go up $9 in the next 3 days? Yes, that's why this option is worth 9 cents right now. But for every day that goes by that Walmart does not reach $149, this value here will go lower and lower until it drops to zero. And when both of these drops to zero, I would have made 100% of the proceeds from selling these options, which is $38. And we can take a look at the option chain here to see how likely it is for Walmart to reach $149 by the end of the week. So I'm on the August 19th expiration date. You can see the implied volatility is down a lot since yesterday. It went from like 52, 53 down to now 30.8. So that's a huge drop in IV. And of course, The lower the IV, the less valuable the option becomes, which is what I want as an option seller. Okay, so if I look at 149 here, there's about a 5% chance, if you look at the delta, of Walmart reaching $149 within the next 3 days. That's a pretty low probability, so I'm going to let this basically ride and not going to touch that. Right now, if I sell it, I can turn this unrealized profit, $27, into a realized profit. But because there's a 95% chance this will expire worthless, I want to take that chance to try and make that $10 extra so that I can make the full $38, which is the total premium I received from selling these options. Now let's take a look at Home Depot. It also went up today, 3%, and it is within these two lines here, the call and the put. So I am going to, again, just leave this and not close my position for this one today. And hopefully I'll get the remaining $15 by the end of Friday, basically. Okay, finally, C Limited. Let's take a look at that one. And remember, this one is the one with really high volatility, so expect this to move a lot after earnings report. And it looks like it did here, 12% down. So unlike the other two, this one went down instead of up, and it's still above the put strike that I have down here. But it is not far away, right? The put price I have at $70, I think, and it's at $79 right now. So I'm going to expect not a lot of gains from my short strangle on this option. Let's take a look at my account here, looking at C Limited. I have two short strangles here. This one I made before, but the one I made yesterday, for the purpose of making this video, it's this one here, 70, 140. So 70 is the put, 140 is the call. And you can see the call is basically worthless. There's basically no chance it can rise from $80 to 140. This stock is volatile, but it's not like a meme stock. It's not like a penny stock that goes up and down 50% in a day. So virtually no chance of the call option expiring in the money, but the put option, maybe. You can see I sold it yesterday for $19, and today the put is worth $12. So it has gone down thanks to that IV crush. If I go to C Limited, yesterday it was over 100%, and now it's 71%. So because of that huge drop in implied volatility, the options are not going to be worth as much, which is why the value of the option has gone down a lot. So now it's $12. So let's see how likely it is to hit $70 by the end of this week. The put looks like about 5% chance, so not very likely. But because this is a very volatile stock, maybe just for this one, I will close out this position. The way you can close out a short strangle, like I'm going to decide to do now, because I don't want to risk, like, yeah, I only made $10 for this trade. If I close this out now, I basically forfeit the other $12, but I don't risk losing money because if C Limited goes down to like $65, I'm going to be losing a lot of money on this trade. It's not likely to happen, but there's always that possibility. So one way to close this out is just right click, close, and what that'll do is close out both of these options, the call and the put. The problem is then you're paying commission fees for two transactions. I don't care about the call, so I'm just going to close out my put, so I only pay one transaction fee. So I can just right click on just the put itself instead of the entire short strangle, and I can click on close, or I can click on buy, because I sold this put option. That's why there's a negative position here. So I can buy it back, which will close my position. So now I have a put option, $70 strike, and I'm going to buy it back. And I will buy it back at, let's say, the mid price and transmit. Okay, so this is the money I have to pay, $15, which is fine because I made $20 or $30 yesterday. Let's go a little bit higher to the ask, and this will fill.
Order filled.
Okay, so that filled at $15. So even though I closed my position, I still made a profit, right? Because I made a profit from the $4 that the call was worth. Actually, if I go to the option area here, that 140 call should still be here. Because what I've basically done is separate the short strangle, and I've sold the put option, but I still have the call. So sometimes you can capture 100% of the premiums, like what I'm trying to do with Home Depot and with Walmart. Other times, like with C Limited, I'm closing out early. It's a new day. Let's take a look at some new stocks and see what we can do. So today is Tuesday. That means I'm going to look at the companies in these two columns here after close on Tuesday and before open on Wednesday. because these will have very high implied volatilities today, but tomorrow, after the market is open, these companies will likely have very low implied volatility relative to today. So let's take a look at Target, and then maybe we'll do Lowe's after. These two stocks are, I think, companies that most people know about. So Target. I know in the most recent quarter they tanked because there were some inventory issues and consumer spending was down. So huge disappointment last quarter. I think that was an anomaly. We probably won't get something like that this time around, especially when Walmart just released earnings and the stock is up 5%. So let's say it could fluctuate either way by about 20%. Go to the chart. What would that look like? So 20% from today, 179, would be at 214. So 214 is like all the way up here. I don't think it's going to go that high. There's a chance that it could fill this large gap over here and go all the way up to this 200-day moving average, which will be a nice resistance as it was support before and then it fell through in May of this year and it looks like it's having trouble climbing back up. So if it does go up again, I would expect it to at least pause or bounce from this support level, come down a bit before getting more momentum to go back up if it does that. So I think 209 or 210 would be a good point up there. If it does come back down, I would expect it to fall back around maybe this level or even the bottom, which is over here at 140. You can see the IV for Target today is massive. It's 103. So 210 is here, and it looks like okay, I can make around $56, maybe 55 after commission. So I'm going to click on that. And then on the put side, I think somewhere around 140. That would be right over here, pretty far down. So maybe I'll go up a little bit to like 143, which will give me roughly a 2% delta, and I can make more money, $10 rather than what it was before. Like for the price, I will choose. Let's go to 70, which is the mid, and then I'll go one higher to 71 to try and make an extra dollar. And gonna wait for that to go through. In the meantime, I can take a look at the next one, which is Lowe's. 10% up, 8% down, about 10% up. It looks like the fluctuation is going to be around 10%. So I'm going to place a line there to represent where I think the call strike price might be. On the downside, if I multiply this by 0.9, I get 191. I would probably feel more comfortable putting the put price down a little bit to like the 187 level because I see stronger support there rather than like up here around 190. Okay, so that's 240 and 187. Let's take a look at the option chain. 240 is over here, $15 to $19 with a delta of 3.6. I think that's fair. And there's actually a 187.5 right here. And let's see how much money I can make from this. About $50, not too bad. I'll say 53 and plus 1. Let's see what the target short strangles price is now. So it's gone down a bit. Okay, so I will go down with it to 69. Let's see if that fills. So I'm going to lower this a little bit more. Okay, now it's at 67. So I'll lower it to 67. And then if that doesn't fill, I'll lower to 66. Okay, so that one filled at 66, and this one, I'll just try to get it to fill quickly here. 51, update. There we go. So let's check back on Wednesday and see how these options are performing. And we can also check back on my Walmart and Home Depot, those short strangles, and see if they are worth less. All right, so it is Wednesday, my dudes, and let's take a look at Walmart and Home Depot and see if they are worth less today than they were yesterday. And it looks like Walmart is, yes, it's worth less. So I'm glad I held on to these positions and did not buy back my options here. And for the Home Depot, also worth less than yesterday. So I sold it at 61, now it's worth 4. Let's talk about the two stocks that I sold options on yesterday, which was Target and Lowe's. So Target unfortunately did not have a good quarter. They had a pretty big miss on their earnings. Nevertheless, the stock is not down too much today, just down about 2%. You can see both the call and the put are basically worthless now. So that's a really nice gain of $63 there. And a huge reason for the option's falling value is because of the IV crush. Yesterday, implied volatility for target was at 103. Today, it has fallen to just 36. So that's really good for option sellers and really bad if you purchased the target option yesterday. Okay, let's take a look at lows. They had a mixed quarter, so it wasn't too bad, but it also wasn't great either. And what happened with the stock is pretty much flat, up about 1%, but not much movement. And of course, that's really good if you have short strangles because you do not want the stock price to move very much. That's ideally how you make the most money. So Lowe's is here, and you can see it dropped in price from 49 to just $6. And that's because both the call and the put are pretty much worthless now, about 3 cents each. But this is going to go to zero by the end of the week, which is only just 2 days away. So for both Lowe's and Target, I'm going to leave them and not close them out like I did with C Limited. And it's a good thing I closed out C Limited, even though I didn't make a huge profit from it. As you can see today, the stock continued to go down. So now it's at $71, and the put strike I had was $70. So over the next 2 days, it's likely that this could go down below $70, and I would be losing a lot of money on that trade. So that's why if the stock moves up or down a lot right after earnings, it's a good idea to close the position, even if you have to take a small loss, because it's better than waiting and risking taking a larger loss later. Okay, so in terms of new options I want to put on today, let's go with a couple more. Maybe we'll do Cisco and then Estee Lauder here. So if the share price jumps up 10%, we're looking at around 51 or 52. There is a 200 moving average here as well, so I'd probably want to set my call strike somewhere there. And on the downside, pretty close to this support level, maybe around 40 or 41, right around there. So in the option chain here for Cisco, I'm looking at August 19th expiration. I'll probably go with $52 for the strike, and then for the put option, I'm looking at the delta here. I'm looking at around 5%, so 41, 40.5. 41 seems to be a safer bet, so I'll be selling that leg. Now this one is not going to make a lot of money. As you can see, just $10 or $11. So I'm going to up the quantity to maybe 3, and that way it'll turn out to be about $30. And for risk management, I'm doing it for this one because it's a cheaper stock. The other stocks that I'm selling options are like in the hundreds or $200 range. This one is cheaper, so I can afford a higher quantity. I'll submit order. Okay, so while I wait for that to go through, let's take a look at Estee Lauder. So I'm going to assume 10% movement in either direction. Price is 276 right now. If it goes up about 10%, we're looking at just over 300. But there isn't really any resistance lines here, and it's way above the 200 moving average. So maybe I'll go to somewhere
Order
around here.
partially filled.
It
Order
looks like
filled.
yeah, okay, so the Cisco short strangle just filled at 11 cent. That looks good. Okay, for EL here, I'll put the call option around 320. And for the put option, I see a nice support here at around the 240 range. I don't need to go all the way down here because that would be like a 15% decrease. It would be very unlikely for the stock to move that much in a single day, but this is roughly the range I'm looking at. 320 for the call and 240 for the put. So 320 would be right here. That's 10 cents. And then 240 would be here, and that would be 30 cents. So let's try to make 55 if we can from this. Maybe $56. It looks like 56 isn't going to fill, so I'll drop this down to 51, which is the current mid price. And I just need that one to fill. It's chasing this down, let's say 45. That should get filled anytime now.
Order filled.
Here we go. Oh, it actually filled at 49. Okay, that's better than I expected. Well, that's a happy accident. So I have two new short strangles. I have Cisco here with a 41 put, 52 call, and Estee Lauder. If the stock drops below 240, maybe I'll pick it up. I don't know too much about the company, but my wife seems to like it. So after I do some more research on it, we could end up with 100 shares of EL in our portfolio, but I'm not going to buy it at market price. If I do buy the stock, it'll be through options. Because if I can buy it at 240 within a couple of days, assuming this gets assigned, that's still a much better price to pay than today's price at 277. So let's jump to Thursday tomorrow for the final day of option trading. All right, so today is the morning of Thursday. Let's check out how those two stocks are doing. Cisco had a really nice quarter, beat both top line and bottom line. So it makes sense that the stock is up today, which you can see it's right here. It filled this gap back in May, and now it's trading at about 49.50. You can see it's still below this top call option strike price here, so still within my short strangle range. However, that's getting a little bit uncomfortably high to the upper line here. So I might want to close this call option in case it goes higher. In terms of Estee Lauder, they did not do so well and faced a lot of challenges this quarter. And it started today at 270 from the bad earnings news. But then for some reason, it started to go up, and now we're actually at 283. However, it's still very comfortably within the spread of my short strangles call and put. So this one is still way out of the money. So the short strangle is probably worth a lot less. At this point, I've probably captured 80 to 90% of the entire value of the options I sold for EL. So let's take a look at my Interactive Brokers account and see how those trades are doing. Cisco right here, 41.52. It's getting closer to that $52 strike. So it went up by $2.80 today. If it does that again tomorrow, then I'll be in the money. So I'll probably want to close this one, but just the call. You can see the put option is pretty much worthless. It's at $0 right now. The call option, it did go down a little bit, and that's totally thanks to the IV crush and a little bit of theta decay as well. But you can see for Cisco's IV, it's at 31% today. And then for the EL short strangle, it's only worth 5 cents now compared to 46 cents when I sold it yesterday. And if I open this up, we can see the call option almost worthless, the put option almost worthless. And that's because based on the stock price, it's pretty much in the middle of these two strikes. And it's highly unlikely for the stock to go all the way up to 320 or all the way down to 240 by the end of tomorrow, which is only a day away. So if we take a look at the option chain for EL. For the stock to drop to 240, that's less than a 1% chance. And for the stock to go up to 320, also less than a 1% chance by looking at the delta here, 8/10 of a percent. So very, very unlikely. So I assume this remaining 5 cents here will get eroded away by theta at the end of tomorrow. So I'm going to leave this one, but for Cisco, I'm going to close out the call because I don't feel comfortable with the current stock price being just $2.50 away from my call strike. So I'm going to right click on this and close. And I'll try to buy it back at 2 cents. That seems pretty cheap. And I have 3 contracts, so that's about $6 plus commission. Not much. So if I close that out, I will make maybe $16 after commission. So similar to C Limited, not a huge profit, but nevertheless, a profit is still a profit. So I'm going to end today by trading Applied Materials, which will announce their earnings after the market close today, and also John Deere. Okay, for AMAT, it looks like back in May and June, there was some strong resistance here around the 120 mark. So I'm going to place a line there. For the put, over here is where we had resistance before, but after the stock broke through, it became a support level, and you can see it bounced from that a bit. So that's going to be the bottom, about $99, and then the top for my call would be 120. So let's take a look at the option chain here. At 120, I'm going to sell that one. The delta is 6.1. That's pretty good. And then around $99 or $98 for my put, also with a roughly 6 delta. So I'm going to click on that one, and maybe I'll make 30 cents, which will translate to $30 for this. And that's a pretty good IV on this. It'll probably go down a lot tomorrow, so we'll capture most of this $30 value. Okay, and going to Deere and Company, maybe for this one to pick the strike prices, I'll do something a little bit different because it's the last one, just to show different ways you can come up with the strike price targets for your calls and puts. What I'll do is use double the implied move of this stock. So I'm going to start with the option chain and look at the strike price that is closest to the current price of the stock. Current price is 365, and it looks like it's this one here. So what I'll do is take the sum of the call option and the put option. So the call option looks like it's about $8.7. I'm trying to take the average of the bid and the ask. And on the put side, looks like it's about 8.6. So I will add 8.6 onto that, and that'll give me 17.3. So this represents the implied move of this option. Now, because I want to be more safe with my trade, I'm going to double this, so times 2, and this will give me roughly $35. So I'm going to take the current price and go $35 in either direction to set my prices. So 365, if I add 35 to this, will give me 400. That's going to be my call strike. And then 365 minus 35, 330 will be roughly where I want my put option to be. And that's a very healthy IV here, 94%. So I'm assuming I can make at least like $60 or $70 from this short strangle here, assuming everything goes well, of course. So the mid price is 69 cents. I'll see if I can get a little bit higher, maybe 73 cents. So after commission, it'll be roughly $70 is what it translates to. And I'll submit that. Okay, so it looks like those options filled. Cisco, I bought back at $2, so I don't have to worry about the stock going up past 52. I just closed that position. For the new trades that I'd made today, Deere, it actually filled at 64. Not too bad. And then for AMAT, short strangle, filled at 27. So if both of these short strangles were to expire out of the money, then I would capture that entire value of about $90. And because there's only 1 day remaining, it's very unlikely for any of the options within these strategies to become in the money because they only have Friday remaining to move, which is tomorrow. So let's jump over there right now. Hey everyone, happy Friday. Finally, we can wrap things up and see how these trades have gone. So it's the last day of the week. I'm not going to make any new trades today, but we'll just review the previous trades, starting from the most recent earnings announcements. So Deere missed a little bit and Applied Materials beat, but none were huge surprises in either direction. So Deere's stock price is 366, pretty much unchanged from yesterday. And then for Applied Materials, similar thing. This one actually dropped more. I mean, the whole stock market is down today, but still within these two lines. So I'm going to leave them both, and I think they will both expire out of the money this week. So at the end of the week, I always like to review my options just in case I have to close something and I might have missed it before. I've traded other options this week, but we'll just go over the short strangles that I talked about in this video. So for AMAT, I sold it. That's my average price, 24 cents. Now it's pretty much worthless and it'll expire worthless by the end of today. Deere, that's going to turn into a nice $62 profit. EL going to realize that $46 gain. Home Depot, $61 gain. Lowe's expiring worthless. Target expiring worthless. And finally, Walmart worthless. The only two options I did not account for just now are C Limited and Cisco, and that's because I closed those options early. So here's a look at the short strangles I've sold for these stocks, and these are all of the realized profits that I'm going to make or I've already made. So the C Limited and Cisco, I closed them, so those are already locked in, but these other ones that are expiring today should all expire out of the money, so I'm assuming I'm capturing 100% of the gains. So if I add them all together, I get $372. Now I got lucky this week because I didn't have any losses. Sometimes if the stock price moves a lot after earnings, then you'll end up with a loss on your trade. It didn't happen this time, but maybe 1 out of every 10 trades you might see a loss, and that's okay because no system is perfect for trading. But what's important about a strategy is if you do it consistently, do you make more profits than losses? And I think in this case, it seems to work out for me, so I'm going to continue doing it. Now, there's a lot more to trading short strangles on earnings than what I'm just showing in this video, because I would say this is a intermediate to advanced options trading strategy that I wouldn't recommend to beginner option traders. Because technically, doing something like this has unlimited risk and you can easily lose a lot of money very quickly. To give you an example, remember how I closed my C limited option, right? Because I realized that the stock was going against me very quickly. So you have to keep on top of those things and you have to know what to do. Because if we take a look at C Limited today, the stock price is trading at 67.16. My put strike was at $70. If I waited until now to close this, so let's say if I buy this back right now, I'm going to pay $290. So instead of a $10 profit here, I would have to put like a negative $280 or something. So you can see how by not managing the trades and not being on top of it, I can easily have a really big loss that's going to cancel out most of the profits that I made this week. So luckily that didn't happen, but that is something that can occur. So unfortunately, this is not a option strategy that everybody can use. If you're new to options, I think a better strategy is to sell monthly put options instead, because then you have a longer time frame. And if you do it on index funds or ETFs, you're at least making a diversified trade. And because the expiration dates are usually a month or two away, the option premiums that you make when you sell those options are going to be much better than the weekly options we've been doing this week. I've actually done an introductory video on how to sell put options. You can click here if you want to check that out. Thank you for tuning in. Good luck with your investments, and I'll talk to you in the next one.